Good afternoon. I'm Mary Conklin, University of Connecticut. Joe Benelli and I have a grant that is hosting this program, Yukon Farm Management Program, in coordination with USDA Risk Management Agency, is providing the funding for this three-part series with the Carrot Project, which has been going great for the last two. So I want to welcome you all here. I want to remind you that you will be getting an evaluation at the end, probably next week. And we ask you to take a few minutes to respond to this. They will provide you with an evaluation sometime in late spring, early winter, to see if you've put anything into action that you've learned in these 3 weeks. And we also ask that you will respond to that. We need to let USDA Risk Management Agency know that we've had a positive impact or some impact from the programming that we do. Please remain muted unless you are asked to unmute. You can write your questions in the chat box, that will be monitored. And we ask that you keep your cameras off. It helps with the Zoom going a lot smoother. So with that, I'm going to turn it over to either Julia, Kian, or Jeff.
Hello, thank you. I'm Julia, and you'll turn it over to me today. Thank you all for having us, and thank you, Mary and Joe, for putting on this fantastic program. It's been wonderful. One of the things that Mary said about getting evaluations, I just wanted to emphasize to fill out these evaluations that she's going to be sending out, because it's these evaluations that support the grants that allow us to keep on doing this programming. So certainly we want to know how we can improve the programming for you. And also we want to ensure that we can continue to get the funding so we can put on this programming for you. One of the things that she had mentioned also was how to put all these things into action. And we're going to talk about that in a little bit. The Carrot Project is going to provide support for all of you to help you put these principles into action. So I know Jeff will be talking about that at the end, but just a reminder that we are here for you to not only help you today, but in the long term to ensure that you can utilize these tools and be successful. I think you're all familiar with the Carrot Project by now. We've been telling you all about the wonderful things that we do to support farmers, so I'll skip over that. We do have a lot of services that Jeff is going to be talking about at the end of today's session. My name is Julia Shanks. I met you all 2 weeks ago. I'm the Senior Business Advisor for the Carrot Project. I'm also a QuickBooks Certified Pro Advisor. And Kian Dalzell is here with us also. He's going to be helping to monitor the chat window. He was your fearless leader last week, talking about sensitivity analysis and scenario planning. As a reminder, if you have questions, don't feel like you have to wait until the end. Ask your questions as we're going along. We may ask you to unmute yourself if it helps to verbally speak out your questions, and certainly you can type your questions into the chat window. We don't want to lose you in the very beginning with a question that can help clarify things. So as you have questions, feel free to chime in. Just a quick disclaimer, today we're going to be doing some cash flow budgeting and break-even analysis, and we're going to use some case studies to help illustrate these concepts. And these numbers are totally fictitious and for illustrative purposes only. If they look like a farm, you know, they're not. They are made up and make believe. So just as a reminder of where we were and where we're going, the first week we talked about bookkeeping systems and, how do you get all the numbers to help you do this analysis that we've been doing. Last week we did scenario planning and sensitivity analysis, and we're going to actually pull on a lot of the concepts we talked about last week, this week when we talk about cash flow budgeting and break-even analysis. And next week and onward, after the trainings, we're going to talk about how we can put this all into practice. Obviously, we are here to support you. So help you utilize these tools going forward. So my agenda for today is to reinforce some of the basics, talk about some of the things we discussed last week, and then we're going to talk about cash flow budgeting and break-even analysis. If there's anything that you want to address today, this is our last session, our last formal session. So if there are any questions that you want to make sure we're addressing today, go ahead and type those into the chat window. And for as much as I can, I will try to answer them as we go along. So the first concept, the first tool we're going to talk about today, we've been talking about a lot of tools. We're going to talk about cash flow budgeting. And cash flow budgeting is so important. You want to make sure you have cash in the bank at all times. And by creating a budget, you know what you have and you can plan for any ups and downs. You can have a clear path to get there. And if you have a cash flow budget, you can use that to compare where you actually are to what you thought you would do so that you can make adjustments quickly. If you don't have a budget and things aren't going quite as you planned, you're not quite sure how to adapt because you weren't sure where you were going. So creating a cash flow budget can really help you map out a path to get to where you want to be and stay in a cash positive situation. So before we get into the process of creating a cash flow budget, I want to talk about some foundational things. I want to define some terms. I want to clarify the difference between cash flow and cash position. And then we'll also talk about fixed and variable costs. And I know we talked about that last week with the scenario planning and sensitivity analysis, and we're going to apply these concepts again today. So basically, we're talking about getting to the bottom line. Certainly we're accustomed to talking about revenue and sales, and we have our operating expenses, and revenue minus operating expenses equals our net income. But beyond our net income, there are other things that go on in our business. We want to make investments in the farm. Perhaps we're buying a new tractor or a greenhouse, or we're making improvements to the infrastructure. We may have some debt service. We got our business launched and we have that greenhouse that we bought 3 years ago. We got that tractor in the truck and we're still paying debt on it. So we have to have enough net income to cover new investments in the farm and also debt service. And so the net cash flow from the business is more than just, incorporating the net income. It's incorporating all the other things that go on in our business aside from the basic operation. So, we look about this net cash flow and we need to know, can we pay ourselves? Do we have enough to live well, live full, wholehearted lives? And do we have off-farm income that can perhaps supplement what's going on in the business? And, I just want to comment that there's no shame in having off-farm income to supplement the on-farm income. You think about it today, how many married couples have two incomes? Today's lifestyle doesn't necessarily make sense that a family of 4 or 6 can be supported by a single income. So, to have your farm income, you may have a spouse that works or a partner that works off farm, and that's okay. But the important thing is that you understand what your cash flow needs are, what your cash flow from your business is, and what you need to do to make it all work. So I want to talk about just some key terms, and I've started to allude to them already, and I just want to clarify them now. First of all, I want to talk about revenue. So revenue is not the same as cash inflow. Revenue is what comes into the business through the process of selling your product or what you're in the business of doing. So if you're in the business of raising chickens, then your revenue comes from selling chickens. If you're in the business of growing vegetables and flowers, your revenue is the result of selling your flowers and your vegetables. You may not always get cash with that revenue. As an example, if you're selling wholesale, you may eventually get the cash, but the cash is not necessarily an immediate thing. So it's cash or expected cash that will come in as the result of selling your product. And, I'm sort of alluding here right now, there's a difference between net income and cash flow. And this is actually one of the ways that net income and cash flow are not the same, that you can have revenue, but it doesn't always mean that you have cash if your customers don't pay you on time. Your operating expenses are the transactions, the things that go on related to the business, to pay the bills, to pay the feed costs, the payroll costs, rent, insurance. And these are the things that the expenses, the cash outflows that are resultant from operating your business. And, I say the cash that goes out or is expected to go out because you may not pay your vendors on time. They may extend to you credit. You may put it on your credit card and not actually have the cash going out immediately. But there are things that go on in your business that are not necessarily operating expenses. They're outflows that are not necessarily operating expenses, things like paying back a loan. So we can have a cash outflow from operating expenses, but we can also have cash outflows from other activities. So net income is not necessarily resultant in cash flow. We also have debt service, and this is, a reality of being in business, is that sometimes you need to borrow money. And debt service is the combination of the principal and the interest expense. So as an example, when you take out a loan, we get charged interest. And every time we make a loan repayment, we're paying part of the base of the loan, the principal, and part an interest expense. So debt service is the combined principal and interest expense. And net cash flow is the total cash that flows in and out of the business as a result of all the different activities in your business. We have the operations of the business, we have the revenue and the operating expenses. We have the debt service, which is the principal repayments. We might have cash coming in because we borrowed money. We also have investing activities that go on in our business. We may purchase equipment like a tractor or a greenhouse or land. So we may have cash flowing out because we invest in our business. And we may have cash coming in because of investing activities. If we sell that tractor, we may get $3,000, let's say. So there's little bits of information that kind of go on in different parts of the business. And obviously they're all tied together, but they all have sort of their unique place in this whole picture of cash flow and operations. How are folks doing? Or do folks have any questions so far? Are you all familiar with these terms? Okay. Hannah's good. Awesome. Thank you. So I think you've all heard the expression cash is royalty, and it is true. We talk about percentage points and things like that, but you can't take percentage points to the bank, you take cash to the bank. And I want to clarify the difference between cash flow and cash position, because a negative cash flow isn't necessarily a bad thing. And I want to show you what I mean. So let's say in January, you start out with $2,000 in the bank. And let's say you're a CSA farm and you have $5,000 of CSA shares that come in. You spend $1,000, buying seeds and new supplies to get the season up and running. And your change in cash is $4,000. You started out with $2,000. You had $5,000 come in, $1,000 goes out. The net change is $4,000, and you end with $6,000 in the bank. Now, on January 31st at 11:59 p.m., you have $6,000 in the bank. And on February 1st at 12:01 a.m., you still have $6,000 in the bank. In other words, your ending cash balance on 1 month is the beginning cash balance in the next month. And the ending cash balance in February is going to be your beginning cash balance in March. And the reason why I want to clarify this is that there's a linear flow to this. So as you're creating your cash flow budgets and thinking about, how does it all impact each other, what's going on in January is going to impact February, March, all the way down the line to December. So we really need to see the full picture of cash flow, not just, 1 month in isolation, because each month is going to impact the months subsequently, down the line. So in January, you started out with $2,000, you had a change in cash of $4,000, and your ending cash balance was $6,000. And in this case in January, you have a positive cash flow, more cash came into the business than went out, and you have a positive cash position. You still have cash in the bank. Now, let's say in February, you get more CSA subscriptions, you get $7,000 in CSA subscriptions, and you're like, you know what, I'm investing in that greenhouse. I got to get that up in March if I'm going to get my seeds going. So you invest, $12,000 in a greenhouse. The change in cash is negative 5,000. If you had 7,000 coming in and 12,000 going out, you had more going out than coming in. It was a net negative $5,000. And your ending cash balance is $1,000. So we showed a negative cash flow. More cash left the business than came in, but we still have a positive cash position. We have cash in the bank. So, we bought a greenhouse. We had a negative cash flow. That's okay. So I just want to be clear that just because more cash left than came in, it's not necessarily a bad thing. This is an example of, planned cash flows. You had the money in the bank and you spent it, you invested it in the business. Awesome. Where we run into trouble is, let's say in March, you start out the month with $1,000 in the bank. You've got, some cash coming in. You're still making more investments. Now you're, getting some more supplies and packaging and fertilizer and feed and all these things. And you got 11,000 going out. Not necessarily a bad thing. Cash outflow is okay. And, in many circumstances, but the net change in cash puts us into a negative cash position. So we had more cash leaving the business, and we had more cash leaving the business than we had in the bank, and we have a negative cash position. So mathematically, this is possible. In reality, this doesn't work. If you have a quote unquote negative cash position, that means you've overdrawn your checking account, you're bouncing checks, you're making people angry at you, and you're going to have problems. You're going to incur, fees and fines and so on. So as we think about a cash flow budget, we want to see, the impact of our decisions in 1 month and how they carry down months later. And if we can project out that we may be in a negative cash position, then we need to consider, what do we need to change upstream? Perhaps we shouldn't have gotten that $12,000 greenhouse then. Maybe we needed to do something differently here. Perhaps we needed to improve our cash inflows. What did we need to do upstream to prevent this? And maybe this is all what we need to do, and we need to borrow money. But creating this cash flow budget, and we can see the flow of how things will go, helps us to plan and project and make sure that we stay in a positive cash position. Do folks have questions about this? So the third concept I want to talk about, and this is actually going to play into both cash flow budgeting and also into break-even analysis. And I know you all talked about this last week in terms of scenario planning, and that is the concept of fixed costs versus variable costs. And your fixed costs are things that don't change as a result of your business volume. So things like liability insurance, accountant fees, bank fees. Certainly they may vary over time. They may go up, they may go down. I had actually one of my website web hosting expenses decreased. It's still fixed every month, but it's $1 less now than it used to be. Go figure. So fixed costs don't mean that they don't change, but they don't change as the result of your production. Variable costs, by contrast, change as you produce more. So you grow more tomatoes, you buy more seeds and seedlings. You raise more chickens, you buy more animal feed. You grow more vegetables, and you need to hire more people to harvest, so your payroll goes up. And these variable costs vary as a result of your production output. And one of the questions that I ask if I'm trying to decide if it's a variable cost or a fixed cost, or a fixed cost, if I grow more tomatoes, if I'm a tomato farmer, if I were to grow another tomato, would this go up? If I were to grow another tomato, would this go up? So, is your insurance going to go up as a result of growing more tomatoes? No, it may go up, but not because you grew more tomatoes. So as we start to think about how our costs are going to change as a result of changes in our business, it's really helpful to understand which expenses are fixed and which expenses are variable. So when you do cash flow budgeting, we can sort of do an annual budget. And I know last week with the scenario planning, you sort of looked at like, how does this thing look on a 1 year chunk of time? And you're like, okay, well, over the course of the year, I'm going to make 100,000 in revenue. I'm going to have 80,000 in expenses, and I'm going to have a net profit of $20,000. Fantastic. But we know that life is not even, and we're going to have ebbs and flows in our business, and we're going to have a lot of cash outflow in the beginning of the year and more cash inflow at the end of the year. And so we want to make sure that even though we know on the whole, if we can just, get ourselves to December white knuckled, we'll be fine. We need to make sure that we can get through those ebbs and flows of our business. And and this is how it happens. This is not an unusual thing, but we need to plan and project for it. We can also do cash flow budgeting to see the impact of various decisions on our business and our cash flow. And as we consider, making capital purchases, we can evaluate when the best time is to make these purchases based on our cash flow and if we need to borrow money. So the process for creating a budget, and I want to say, we have budget, we have projections, and projections are often, what we provide to lenders if we're borrowing money. Budgets are what we do kind of, year to year, but the process is the same. So, sometimes you'll be creating a budget, sometimes you're creating projections, more or less it's the same thing. So the process and what we're going to do today, we're going to go through this. We want to look at the previous year. And as we review the previous year, it's always a good idea just to see how things went. What can we do to improve? We'll want to consider the changes that we want to make for the upcoming year. We then outline the revenue, expenses, capital purchases, and financing. We need to check our cash flow and make adjustments as necessary. So to review the previous year, run a report. If you all have QuickBooks or Excel, you want to run a profit and loss statement or an income statement. As you consider the changes for the coming year, it helps to include all the decision makers. So you may be the owner of the business, but you might have a partner, either life partner or business partner. If you have a farm manager, it might be helpful to bring people in to, get everyone's insight. In terms of outlining your revenue expenses, I'm going to walk you all through a dynamic spreadsheet. And when I say dynamic, what I mean is that we're using cell references to make sure that we can see the impact of our decisions down the line. And I'll show you what I mean when we get into the spreadsheet. And we'll talk about, I'm going to talk about the mechanics of it. I know that last week, when you did the scenario planning with Kian, we talked about different ways to outline the revenue, and he talked about, based on production expectations versus sales expectations, what you think you can do, what you need to do. So I don't want to rehash that today. Certainly you can go back to the video from last week, or we can set up a one-on-one coaching call to talk about these things. So we'll want to outline those changes and then check cash flow as necessary. So before we go into the Excel spreadsheet, do folks have any questions? Okay, so Steve, let's see, just readjusting my screens with the spreadsheet. You need to look at next year to project feed expenses, but I don't have a history. So how do I get started? 40 turkeys, 150 ducks, 5 pigs, etc. So that's really hard, Steve. If you don't have history, how do you make a projection? And a couple of things. First of all, you can always talk to other farmers to see what they're doing. What's the expectation? I know, I'm actually curious, are there any livestock farmers here on the call who might have insights for Steve on how to project those specifics? Haley, do you want to unmute yourself?
Hi.
Hi. Oh, I love it. We have good advice come in. I can tell. How do you project it? You're a livestock farmer?
I use a lot of like other states extension information. So when I was getting into raising dairy cattle, I was finding projections on, how fast they grow, how much feed they eat at each stage of life. And I was doing an estimation for one cow and then multiplying it by how many cows I was expecting and
Yep.
what ages they would be during which quarters of the year.
Wow. So you really got into some detail there. That's awesome.
I'm sure that there are other like turkey farmers and duck farmers, hog farmers. My dad raises pigs, and I'm trying to think of like how much food he goes through. I can't remember, but I know there's a formula for pigs that it's like a certain number of pounds of grain per day per pound of growth.
Yep. Yep.
So if you can find that calculation, that'll be really helpful with the pig estimations.
Yeah. Awesome. Thank you. And you brought up some good points. And, I think this is one of the challenges for a lot of beginning farmers is, where do I start? And I'm sorry, did I say it right? Haley or Hallie? Haley?
Yeah, it's Haley.
Haley, sorry. I just got in trouble today because I've been saying a friend's name wrong for like the last 3 years, and she finally told me I was saying her name wrong. So, trying to be good. I know. But you brought up a good point that you can go to extension. There's a lot of resources out there, and it's all kind of a shot in the dark, especially when you're getting started, because there are going to be inefficiencies. And I mean, something as silly as like, I don't know how to open up the grain bag and I just dropped this whole bag of feed on the ground and I can't salvage it. Things happen. So, we need to, start somewhere. But as we go along, we can then also start setting our own benchmarks. So, if we're keeping a record, we can say, okay, well, this year, this is what I thought I was going to do. This is what I actually do. And then you can start to refine your numbers. And every year you can get better and better at figuring out your numbers. So whether it's talking to fellow farmers, Steve and Haley are here today talking to each other, going out to extension, putting something on paper is better than having nothing, because, as we go through this process of how to create a cash flow budget, you can then see, all right, well, I was wrong on my numbers. Now what adjustments do I need to make going forward? So if you do have numbers, and can everybody see the Excel spreadsheet now that I have going up? People can see Excel? Yes. Awesome. Thanks, Chaz. So, this is, we can export a report from Excel or from QuickBooks into Excel. This has been a little bit reformatted to make it a little bit easier to read. But it helps to, if you can, to run a report by month so you can really see the changes. As we talked about, things are not even. It's like, this farmer did $90,000 in CSA sales, but it's not like they did, 6,000 each month. It was all sort of front loaded. And the labor happens, during the growing season, and the seeds and supplies happen in the beginning of the season. So, things are sort of ebbing and flowing throughout. So seeing this historical breakdown helps us to think about how we might project going forward. And, it's always helpful to also see all of these expenses and revenues as a percentage of our total revenue. So in terms of the income, we can see, what was our sales mix? We did 76% of sales through the CSA, 18% through the farm stand. So as we think about changes for the next year, how was the CSA? Do we want to grow the CSA? Do we want to keep it the same? If we're going to grow our business, then how might we change? Do we want to expand wholesale, or do we want to expand the farm stand? So consider the changes of what you want to make, of what you want to do. And I know, like I said, Kian talked about this last week. One of the ways that you might want to think about revenue projections is, what do you need to do to make it work? So if you know that you're going to have all of these expenses and all of these expenses, and you have, your debt service, and you want to make some investments in the business, then you can say, how much revenue do I need to make all of this work? And that's the second tool that we're going to talk about today, is the break-even analysis. That can also be a way to help us evaluate what we need to do and start setting some revenue goals. So as we think about the changes that we want to make, we obviously can, have different tools to project out our revenue. And then in terms of our expenses, we're breaking them out by variable expenses and by fixed expenses. So the variable expenses, we're looking at those as a percentage. So as we start to think about how things may change, we know, for example, that our labor last year was 38%. It was $45,000, but it was 38% of our revenue. So as we think about growing our business, it can sometimes be helpful to think about it as a percentage as opposed to a dollar amount, because we know as we grow our business, we're going to have to pay for more labor, and we're going to have to pay for more seeds and more packaging. So sometimes it can be helpful to think about what our expenses will be as a percentage of revenue. So let me show you what I mean as we take the next step forward to make assumptions. Oh, whoops. Hang on a sec. I'm going to stop sharing. I realized I forgot to do something in my spreadsheet. Stand by 1 second. I'm just going to do something. And we're going to share this template with you. So if you find this template helpful, fear not, we will share it with you at the end of today so you can use it on your own. Okay, so here is the, here's our historicals. And now we want to start making our assumptions. I apologize. I was making some updates to this morning, and I forgot to make it presentable again. So let's say we want to set a growth rate. And again, there are different ways that we can project out revenue, but let's say we did, 90,000 in revenue last year from our CSA, and maybe we want to grow at 20%. So I'm going to put 20% into the growth rate, and that's going to automatically populate 108,000. And this is certainly an opportunity for a gut check. How does that feel? Do I feel like 108,000? And I may want to play around with it. Maybe I'm like, you know what, I can do more than that. Maybe I want to do a 30% growth and see what that looks like. Delivery was really popular last year. I think I'm going to grow my delivery. I want to do more. And you know what? I think I want to increase the price of delivery because people really liked it. So maybe I'm going to grow my delivery 40%. The farm stand, I'm thinking I might want to build a little more infrastructure. I'm going to do a little more marketing. I really think I can grow that 50%. And my wholesale, you know what? I want to really expand that. I'm going to grow that 200%, let's say. I'm going to get, 5 more customers. So we can start to, project out. Now, the way this spreadsheet is set up, it's set up by growth rate, but you can always say, you know what? I think I want to grow my wholesale. I really want to grow that to 20,000. So I'm not even going to put in a percentage. I can just, put in the number that I think it will be. Now, when we get down to our different expenses, we have our expenses here categorized very conveniently by variable expenses and by fixed expenses. So as we think about our variable expenses, we talked about, well, it was 38%, my labor was 38% of revenue. So if my labor is going to be 38% of revenue, obviously my revenue has increased, or my projected revenue has increased. So presumably my projected labor is going to increase as well. So I can put in, that 38.2% and see what does that look like. Now, it isn't always linear. Perhaps, you think that, well, my labor is going up, certainly it's going to be a percentage of revenue, but maybe it's not going to go up as steep because I think there's some more capacity. I can be a little more efficient. So maybe my labor will be 35%. Our production supplies what is that going to be as a percentage of revenue? We can start to populate the variable expenses, and then the output is going to be, what is that final number going to be? So if our labor is projected to be $60,000, then we can, see what is that going to look like? So, Kate was asking, where did that 38% come from? So I'm looking at, oops, don't want to move that. I'm looking at my historicals. I have my historicals right next to me, so I can see as I think about what I might do in the future, what did I do in the past? And Kate further asks, doesn't your labor grow with your sales? Absolutely, which is why I am projecting it as a percentage of revenue. So my revenue went up, therefore I think my labor is going to go up as well. So you can see last year I spent $45,000, and I'm projecting that this year I will spend $60,000. Now, the percentage of revenue may or may not go up, but the net dollar amount will go up. Does that make sense, Kate? Awesome, thank you. Any other questions about how we look at the variable costs? So the fixed costs, utilities, insurance, professional services, these are not going to go up in direct correlation to our production. So, hopefully you have a fixed rate mortgage. So if your mortgage expense was $18,000 last year, presumably it's going to be $18,000 this year. Your utilities, maybe there was a 3% hike, but that's not 3% because your revenue went up. It's 3% because the utility company said it's going to be 3% higher. So, maybe you just want to do, 4,000 times 1.03, which would be a 3% increase. So maybe you'll project out, 4,100 for utilities. Maybe your insurance is going up, and hopefully your insurance isn't going up as much as my health insurance is going up this year. Holy smokes. But maybe you want to just sort of say it's going to go up 15%. So maybe it's going to go up. Maybe, this number will change. But these numbers aren't changing because your production went up. They're changing because inflation and, other outside factors. If you spent $2,400 on utilities or on office supplies, excuse me, maybe you'll spend $3,000 on office supplies this year. So, it's somewhat painstaking. You do need to go line by line. And it really helps to use your historical financial statements because it will help you not forget any line items. Sometimes people create their budgets, outside of QuickBooks, isolated from their bookkeeping system. And they may just sort of say, oh, production supplies, oh, payroll. And if you don't look specifically at what you did last year, you might forget a line item. You might forget, $5,000, $10,000 worth of things. And that really can make a huge impact on the viability of your budget. So you've made your assumptions, and, this spreadsheet has sort of, calculated it out. And then, so I made some assumptions and I just carried over the numbers here. So now we need to start breaking it down month by month. So, we've projected out, let's say that we're going to make 99,000 from our CSA. So when do we think the CSA is going to come in? Perhaps we're going to have, 5,000 will start to trickle in January, maybe 7,000 in February. Then we're going to start to get the bulk in March and in April. And in this particular spreadsheet, we have a handy dandy counter. So we can see as we're, filling in our projections that we make sure to allocate the full amount. So, and this can actually be a really good kind of gut check. It's like, okay, well, I said I was going to do 99,000. And boy, if I'm going to do 99,000 in my CSA, then I've really, how is that going to come out month by month? So it can actually be a really good gut check to make sure it's going to happen. So maybe I'm going to do 30,000 in May, 30,000 in May, and then I'm going to get some last scragglers in June. So I've allocated the full CSA. Now for the payroll, I've allocated for myself 46,000. And, I might have, a couple of people coming in March just to help plan the soil. Maybe April, it starts to pick up 15,000. And then, oops, I'm getting a little too aggressive in my payroll. Maybe I have to budget myself to 7,000 in April if I'm going to make it work. So this can also be a way to sort of see, is it all going to work out okay? If this is how I can allocate my payroll, how is it all going to work? So, and actually, Kian, thank you. Great point. Part of the budgeting process is having these checkpoints. So, one of the things that Kian mentioned in the chat was, making sure that you're on budget. If you've set a goal of 99,000 and you think that this is when it's all going to come in and all of this pattern, in April, you can meet with your CSA manager, your marketing people to say, how am I doing? I projected 25,000 in April. Are we going to hit our numbers? Do we need to adjust our marketing, or do we need to adjust something else if things aren't going according to plan? And by having it broken down month by month, we can really sort of set goals, micro goals, if you will, and have check-in points. Likewise, if we have a monthly budget now of $5,000 for labor, we can make sure that we're on track. So I filled out everything here based on, here's the budget. I broke everything down by month based on when I think things are going to happen. And then we can see, for example, we're going to have a negative cash flow in January and February, but we're doing okay. It's like, oops, cancel. We're not going to get ourselves into a negative cash position. Now, let's say, we started the year, we decided to take that vacation to Aruba in December, and we're starting the year with $10,000 instead of $20,000. We can see that we get ourselves into a pickle in February. The way we've sort of projected the cash is going to flow in our business, we're going to have a problem in February. So we need to plan now before we get into that pickle. What do we need to adjust to make it work? Let's say, for example, that you're starting out the year with $20,000 as you had planned, but you're thinking about, making a big purchase here. You want to buy that, that $15,000 greenhouse, which is a negative $15,000 greenhouse. So it's like, oh, that might not work here to buy that greenhouse in February. Maybe I need to delay it until March when I'm going to have a better cash flow position. So having this mapped out, and you can see, ending cash in January, beginning cash in February, ending cash in February is beginning cash in March. And you can see that the formulas are actually laid out that way. So we can see the impact of earlier months all the way down the line to the end of the month. So Steve says, is there going to be enough cash on hand to support these production increases if the CSA payments come in April and May? So that's, as Kian said, great question. And we can see like, well, what happens if we don't get the 26,000 in March and we only get 13,000, and now the extra amount comes here in May, 30,000. Oops, 13,000, that's my problem. There we go. So, you know, what happens if it all gets phase shifted? We can see, if we don't hit our targets in March, if things fall short, we're going to run into problems. So we need to now figure out what adjustments need to be made. So Kate asked, do I take beginning cash and ending cash from my bank statement? So we've got two conversations going on right now, and I think these are both fantastic, but I want to separate them out just to make sure that we're really clear. The first conversation is creating a cash flow budget to make sure that the whole plan works. And, you know, at no point do we get ourselves into trouble with a negative cash situation. So I'm going to take away that greenhouse that we're not going to buy. We stay cash positive the whole time. It is fantastic. The second part is that now we're into the year, we've created our budget, and we're comparing projections to actuals. This is what we thought we would do. And if we did all of these things just like this, then everything would be peaches and cream. Now we, you know, get into real life and things don't go quite as planned. And at the end of January, we want to compare, well, that's what I thought I was going to do. How did I really do? And, you know, at the end of January, you could say, you know what, I took my bank statement and I really only had, you know, 6,000 in the bank at the end of January. So I'm just going to plug in that number and see how that changes things. So that can be part of your projections to actuals. And actually, Jeff, do we have that video up on the website, the projections to actuals video?
I will have to check. I will do that now.
Okay, so I think that's for more resources. We do have a video that I think Kian did actually, and I think it's a terrific video at that, that talks through this process of comparing projections to actuals. So, and Kian says we do have a template for that, and it's a fantastic template, by the way. I have seen it and it is awesome. So that's the general process of creating a budget, a cash flow budget. Again, we are delighted to share this template with you. And if you want more support in doing your own cash flow budget, be in touch with Jeff and he will connect you with one of our business advisors to help support you creating your budget.
And we do have that video posted, the webinar on our website.
Do you want, can you put that link into the chat window?
I can.
Awesome, thank you. Okay, and everybody can see my PowerPoint again? Awesome, thank you. Okay, so we talked about creating a cash flow budget. The next tool that we want to talk about is break-even analysis. And who here has heard of break-even analysis? So Steve has heard of break-even analysis. Have other folks heard of this before? Excellent. Good. And how many of you have done break-even analysis before? Has anybody done it before? Oh, of course you have, Kian. All right. All right, Tim is honest. He has not done it before, and hopefully you will be inspired. I think that break even is like the most magical thing ever. And I find it can be really inspiring to, you know, start to track your numbers so that you can do this kind of analysis on your business. So, you know, break even is sort of that point between profit and loss. And profit is when you have more revenue than expenses. Loss is when your expenses exceed revenue. And break even is when your revenue precisely equals your expenses. You have no profit, you have no loss. And this is the traditional view of the break even point is when you don't have any profit or loss. But we like to think about it a little bit in a more modern perspective, because not only do we need to cover our operating expenses, which is sort of the loss side of things, but we need to cover debt service, which may or may not be included in our income statement. We want to invest in our business, and we want to have a buffer for life. We want to we want to have money for ourselves. It's like, yeah, we broke even, but we want to like go out to dinner or go on vacation, or that trip to Aruba that we're talking about. These are important things. So we want to build this into our plan, not just, what do we need to do to break even, but what do we need to do to break even and live a full, wholehearted life and not just, barely make it. So we really want to build this into our analysis. So our modern view of the break-even point includes a desired profit. And this desired profit is, to create a buffer in case things go awry. It gives you a chance to offer a raise for your employees. It gives you an opportunity to reinvest in the business, to fund a new enterprise, and make sure that there's money for you for, vacation, retirement, your kids' education, food on the table, roof over your head, all of these things that you're in business for. Vacation, Kian, we're going to talk about vacation. It's an important thing, and it really is actually, because I think we all need to recharge sometimes. So it's good to step away sometimes. So this graphic is a little bit overwhelming, I think, but I think it's an important thing to sort of recognize the challenge of break even, because as your revenue goes up, your expenses go up. So how do you sort of figure out how, because if I grow more, I'm going to buy more seeds and I have more, I got to pay more staff on those variable expenses that we were talking about before. Those keep increasing as my revenue increases. So how do we sort of find that point where, our fixed expenses don't increase as much? And so break even is sort of like trying to pull together all the different ways that our expenses change as our business grows, so we can find that point of, what's the level of revenue that we need to do to cover all the different expenses in our business. So before we get into the actual formula, I wanted to go over a few definitions that's going to help get us there. So we talked about revenue. So the money that comes into the business from selling your product. And then we haven't really talked about cost of production. And you might also think about this as your variable costs. So these are the costs associated with generating sales. So as your sales increase, your cost of production increases. And that may be your seeds and farm supplies. It may be payroll. It may be packaging. It may be soil amendments. And these are variable costs, and they're expressed as a percentage. And that formula is cost of production divided by revenue. And your gross profit or your gross margin is what do you have left over to cover your overhead and fixed expenses. So revenue minus cost of production is your gross profit, which is the number. And revenue minus cost of production over revenue is the percentage, which is your gross margin. So the break-even question is asking, how much do you need to sell in order to cover your overhead and debt and still have something left over to pay yourself? So I want to drill down on the concept of gross profit. So revenue minus cost of production, or your variable costs, is your gross profit. So let's say each pound of vegetables costs you $2.70 to produce. And if you sell them for $6 per pound, then your gross profit per pound is $3.30. Therefore, you need to sell how many pounds, which will generate $3.30 to cover your overhead. How many of these $3.30 do you need to cover that big swath of overhead that you have? So if your revenue is $100,000, your cost of production is $30,000, your cost of production is 30%, and your gross profit is $70,000 or 70%. So for every dollar of revenue, 30 cents goes to production, 70 cents is left for everything else. For every dollar, 30% goes to production and 70% is left for everything else. So you can start to see the difference between the percentage and the dollar. So we can start to see the gross margin is what is that percentage of all of our sales that we have left to cover our overhead and our profit. And this may feel like it's redundant, and it is kind of redundant, but I know that everybody processes this information differently. And I think this is a tough concept for a lot of folks. I wanted to explain this in multiple ways, and hopefully we can, pull everybody along in this concept. Hopefully one of these explanations will resonate with you, or maybe more. So another way to look at the difference between gross profit and gross revenue. Another way, this is my favorite way of thinking about gross margin. So if you have $100 in sales, a portion of it is going to go to your cost of production. Poof. And what's left over is what you have for your overhead and your profit. So every time you make some sales, you don't get that full chunk of $100. You only get a portion of it to go towards your savings, towards your profit, and towards your overhead. So if we think about, how does this gross margin figure into the concept of the break-even analysis and the formula, we can say that the gross margin, that some percentage of our break-even sales, so we're going to have X number of sales, and the gross margin percentage is going to be what portion of those sales do we have left over to cover our fixed costs and our desired profit. So do folks understand that premise of the formula, that we know that for every dollar of sales, we're only going to have a percentage of it left for our fixed costs and desired profit? Does this basic premise of a formula make sense to folks? And if not, can you articulate a question? I can't see your faces since everybody's cameras are turned off. So Kate, thank you for your honesty. You're not yet clear on what break-even sales yet are. So break-even sales is, this is what we're trying to get at. What is that magical number that we need to generate in revenue? What volume of sales do we need in order to cover our variable costs, our fixed costs, and our desired profit? And we know that for every dollar that we sell, a portion of it is going to go towards our cost of production. So, and then a portion of it will be our gross margin. So if we sort of go back to this idea that for every dollar that we sell, we only get a certain percentage of it, our gross margin, that's available to cover our profit and our overhead. So what level of sales do we need that we only get a certain percentage of it, our gross margin, and that number needs to be enough to cover our fixed cost and our desired profit. So we're trying to sort of get to that idea of what our break-even sales number is. Does that help clarify that, Kate? So this is the basic premise of how yeah, no, we haven't taught you how to figure out break-even sales yet. I'm getting to that. I am working my way. I'm trying to sort of take us step by step. So now we're going to go back to 8th grade math, which for some of us is a very long time ago. But what I remember from 8th grade math is that if we have an equal sign, and here we've got our little equal sign, what we do to one side, we do to the other side, and it's still going to be equal. So if we divide both sides by the gross margin, and gross margin is also equal to 100% minus variable costs, then we can see that that break-even sales is fixed cost plus desired profit divided by our gross margin, or 100% minus variable costs. So that is the basic formula. And now we're going to talk about how to utilize the formula. And now that we have the formula, Kate, does that further clarify it? Cool. So, where is this data? We have this great formula that if we can sort of get all the data, we'll figure out how to determine our break-even sales. So fixed cost plus desired profit minus 100%, or divided by 100% minus variable costs. So we need to go through our historical financials, and we need to know, is this going to be a fixed cost, or is it going to be a variable cost? Is it overhead, or is it cost of production? So we'll go through and we can categorize each one so we can know where it's all going to fit in. Our fixed costs, we're going to express as a dollar amount. Our variable costs, or our cost of production, we're going to note as a percentage. So we'll need to go through, figure out, what is our cost of production? What is our revenue? And then our desired profit is, what do you need to live well? What do you need to reinvest in your business? Oops. So let's start putting this formula into action. And again, we're going to iterate over this a few times so you can really see how it works. So let's say a farm has $8,000 in overhead and fixed expenses, and they've calculated their cost of production to be 35%. And they've set a goal for themselves of having a $30,000 profit. So what amount of sales do they need to break even in our modern sense of the word, of the term? So we have our formula of fixed cost plus desired profit divided by gross margin. So our fixed cost was $8,000. Our desired profit was $30,000. Our variable cost was 35%. And we can sort of compound the formula, follow it through. And we can see that our break-even sales based on those assumptions would be $58,462. Did that flow make sense to folks? And if you have questions, if it didn't make sense, can you articulate a question?
Can you hear me? Excuse me?
Yeah. Hey, Orville, how's it going?
Oh, not too bad. I'm having a little problem using this Zoom here, but I think this is fairly straightforward, but I think it's going to take a little bit of practice.
Yeah,
you
it
know.
definitely takes practice. So we're going to go over it one more time. Actually, 2 more times, I think, just to
Okay,
see how it works. Yep.
Okay.
So, this first example, I've given you the numbers and it's pretty straightforward. So I'll show you another example. And Kian is, if folks are feeling shy about asking questions publicly, you can message him privately so you don't have to worry about, not knowing this. So here's another example. So Dixon Farm is a vegetable and livestock farm in southeastern Massachusetts. They've been in business for 3 years. And thanks to hawkish budgeting, they've been profitable every year. However, Farmer Dana wants to pay themselves for $50,000 a year and start saving $20,000 so that they can purchase their own land. So the question is, what kind of sales does Dixon Farm need given their current expense structure? So here's our process. We want to go through, we want to classify our expenses as variable or fixed. With the fixed expenses, will they increase as we increase? And we need to evaluate what's our after profit cash need. So what do we need for our owner's draw, investments in the business, loan repayments, and then we'll plug our numbers into the formula. So here's Farmer Dana's financial statement from last year. And she had total revenue of 144,000. And she had these expenses in these amounts. And I also calculated on the side what the numbers were as a percentage of revenue. So, you know, we can decide if it's a variable expense or a fixed expense, but if it's a variable expense, it was 23% of revenue. So 33,000 divided by 144 is 23%. Does that percentage of revenue make sense to folks? All right, so production costs, are those fixed or variable? And this is where you all have to either type into the chat or unmute yourself. Okay, so everybody says production costs are variable. And that's what I said too. General and administrative expenses, are those fixed or variable? Fixed. Anybody else fixed? I said fixed. Payroll expenses, are those fixed or variable? A couple of variables. Rent, is that going to be fixed or variable? Fixed. Oh, Steve says rent is variable. Do you want to say more about that? Oh, changed his mind. Okay, I said fixed too. Got it. Yeah, I appreciate that. Typing, trying to keep up this pace of typing. Repairs and maintenance, fixed or variable? Variable. Variable. Excellent. Okay. So I think we've all sort of decided. Now, obviously, I've consolidated. You may want to, you know, go through your profit and loss with a little bit more detail on each line item. But I added up, I think we were all in agreement what was fixed and variable. For the fixed costs, the rent and the general and admin, I added up those numbers. The variable costs, I added up 23%, 33%, and 2%, and I got to 58%. And we know that the desired profit was $70,000 based on the profit goals and the savings goal. So we have our numbers that we can plug into our formula. So we have, you know, break-even sales, fixed costs plus desired profit divided by 100% minus variable costs. Our fixed cost was 22 and change. Our desired profit was 70,000. Our variable cost was 58%. So we, you know, consolidated 92,000 divided by 42%, and 42% equals 0.42. And our break-even sales, therefore, would be $219,802. So based on Farmer Dana's historical financials and their sales goals or their growth goals, they'll need to do $219,000 of sales to get to that place. Now, you know, we can take this big number, 219, and we can start to break it down. We talked about that last week in terms of setting sales goals, that if you know, I want to do $220,000 in sales, what does that look like? Now, we may need to iterate over this, and I'm going to just skip back to here. So, you know, these fixed costs were based on 144,000. So we may need to go revisit these numbers and say, okay, well, now if I'm going to be doing 220 in sales, you know, maybe this general and admin number is going to be a little bit higher. Am I going to need to increase my desired profit to include investments over time in the business? So we may need to iterate over these numbers to make sure that it still works. So you may want to go through this a second time you know, maybe the fixed cost is going to be 30,000, maybe the desired profit is 80,000, you know, and sort of see where that puts you. You can also use break even to, oh, before I go on to this, actually, how do folks feel about this break even process sort of as a general tool of setting sales goals?
It seems very efficient. It works good. The math works okay.
Awesome, thank you. And sounds like it's working for Haley and Kate. How are the other folks doing? Anna's feeling good. Awesome. And also, I just want to reiterate that, you know it makes sense here and the numbers are all neatly put together, but if you feel like you want to start practicing this and, as you start to work through your own numbers and kind of run into roadblocks, feel free to reach out to Jeff and we'll make sure to get you some one-on-one support. So we can also use the break-even formula to evaluate new opportunities. So we talked about Farmer Dana, on the whole, what do they need to do to make it all work, to set their goals? But, we can also sort of look at it in sort of a microcosm of opportunity. So Jamal and Sarah from Deep Roots Farm have an opportunity to sell at a local farmer's market. It would be a new sales channel for them since they previously only sold at a CSA and on-farm sales. They've decided to, they want to see if it works out, and they decided to do some back of the envelope, back of the napkin, break-even math to see whether they should do more thorough scenario planning. So they're looking at the market, and if they go to the market, they're going to have 15 hours per week of additional labor. They got to pack the truck, drive to market, set up, sell, break down, unpack, drive back to the farm, or break down, pack up the truck, drive back to the farm, and unpack back at the farm. And they figured that that would be 15 hours of additional labor per market. Then in addition, you're going to have the market fees, you're going to have packaging, you're going to have to buy tents and tables and displays and fuel to get to the market. And then obviously you would have your cost of production. I'm getting distracted by MJ Eads' question that that this works well with a simplistic single revenue stream, but what about a business that has multiple revenue streams that could also play off of each other? Yes, and so to Kian's point, we can definitely help with that level of data, but you may want to do a weighted average cost of production. So, if 50% of your revenue has a 35% cost of production and 50% of your revenue has a 45% cost of production, then the weighted average would be a 40% cost of production. So we can sort of work it that way. But, you have to, kind of iterate and nuance around it, a couple of times to see like, well, if I do this, how does it play out? And, we can set, you can set your cash flow budgeting tool to sort of play it out and see how it works and make adjustments. And using classes and QuickBooks, definitely. Sorry, I'm getting distracted by the chat because I think there's a great conversation going on in the chat window as well. Okay, so back to Jamal and Sarah. They're talking about going to sell at the farmer's market. So these are going to be the specific cost to the market as well as the cost of production. So let's talk about filling in some numbers. So they said it was going to be 15 hours at $15 an hour for the labor. The market fee is going to be $25. They're going to spend about $50 on packaging. And then in terms of the tents and displays, I allocated $55 per week. The way I figured it out was that if the total cost was $1,100 to buy the tents and the table and the displays, and they have to make a commitment to 22 weeks at the market, it's going to be on average $55 per week. So we basically allocated the cost of the tents and displays over the entire season. Oops. So if their average cost of production was 45%, then what do they need to sell to make it worthwhile? And let us not forget, what is your get out of bed rate? And I used to talk about this when I was in a catering business. It's like, I don't want to just break even. I don't, it's like, if I'm not making at least $200, it's not worth it. It's like you're breaking even at the market, but what about the overhead at the farm and building your profit? So, what is your get out of bed rate? What is going to make going to that farmer's market worthwhile and make you happy that you are there? And that is going to be your desired profit. So the fixed cost of going to the market is $355 per week. The desired profit is your get out of bed rate, and you all can say what's going to make it worthwhile. I decided that if I didn't make $300, or Jamal and Sarah decided that if they didn't have $300 from the market, it wasn't worth getting out of bed. They know that their cost of production is 45%, so they plug it into their formula. They consolidate the numbers, they convert the 55% to 0.55, and their break-even sales is $1,100, $1,200 per week. So in order for this farmer's market to be worthwhile, they need to average $1,200 per week. Now, that's going to obviously take more analysis to see if it's going to work. Obviously, farmers markets go through variability across the season. When you have less product early in the season and more product later, and then sometimes it rains and peak tomato season and nobody shows up. So obviously, this is going to be an average. But that this, as you go back and evaluate the season, first of all, you make a decision. Do I think I can do $1,200 per week at this market? How many hours? What's the customer count? What product am I selling? I've made the decision. I'm going to go sell at this market. And now at the end of the year, I'm going to go back and evaluate. And I'm going to say, was it really $355 per week? Did I have that number right? And did I generate on average $1,200 per market, so that the following year I can decide, do I want to go back? So, this is an iterative process, and you can do this once and say, yes, no, but then you have to go back and look at your analysis to see if it was right. And if it wasn't right, what adjustments do you need to make so that you can constantly improve on your business and improve your profitability? Any other questions? There's been some great questions going on in the chat. So have folks thought about their desired profit? I'd be curious to hear how you all think about it for your businesses. I know we've got a couple of new farmers, but have you set goals for yourself, and how are you setting goals? I don't know if folks want to unmute themselves, if it's easier than typing in the chat window. So Kate is doing a monthly budget for their family. So Steve, you've been thinking about break even. What are you thinking about break even? Steve, did you want to talk about how you've been thinking about break even?
Hi. I've just been thinking about if, just trying to get my arms around all the different expenses, feed, electricity,
Yep.
fencing, everything else. And, before I even start adding on what kind of profit I want to make, I've just been, as a goal, thinking about how, what kind of sales do I have to do to be able to break even with the current level.
And
So,
you've
unfortunately-
brought up a couple of types of expenses. So you had feed, which is a variable expense.
Sure,
And then you had utilities or electricity,
Yes.
which, I mean, unless you're an indoor growing, I think of electricity more as a fixed expense.
fixed, sure,
And then things like fencing is going to be an investment in the business. So
capital.
a capital expense. So, you know, that would probably fit into the desired profit, if you will.
I forgot
Um,
about labor.
Oh, labor schmaber.
Yeah, yeah. Well,
Um,
if the first part-time person we hired doesn't show up, then I'm out there doing it. So,
Right,
um,
but that's desired profit.
Yes.
So, you know, let me just pull up the formula again. So your desired profit is, you know, if you were to say fixed cost, I have an employee that I pay 15,000 a year, or, you
Right.
know, part-time, whatever.
Yes.
So you could include that labor here, or you put it in your desired profit. So either way, you can sort of say, you know, your labor is going in here somewhere. It's either in
Yes.
desired profit, it's in your fixed cost, or it's in your variable cost. So you definitely want to kind of get it in there somewhere, but you know, if you don't have an employee, then it's coming here from your desired profit.
Sorry, profit, right?
Right. And then in terms of the fencing, you know, one way to think about that is to sort of tack in, let's say, $10,000 into fixed cost to account for depreciation. So depreciation is the impact of all your capital purchases on your income statement. So if you buy a tractor or if you put up fencing, those are, you know, one-time expenses, and they don't necessarily show up on your income statement, and they're not happening every year. And when you record them as an asset and then depreciate them, you're now taking that cash outflow of $10,000 for the fencing, and you've now spread it out over time. So you could put that depreciation expense into your fixed costs as a way to account for the investments in your business that you're making.
Cool.
And Kian also clarifies that if you're using electric fencing for rotational grazing, it may also be variable. And I think, you know, the point is that if you're doing, you know,
Yes.
greenhouse growing, electricity is going to be a variable expense. If you're
Mhm.
doing, you know, field production, electricity will likely be a fixed expense. So it's, you know, really important to understand your business.
Mhm. We have photovoltaic on our barn, 26 panels. So just to make it more complex.
Of course, of
Yes.
course.
And I'm gonna jump in quick, Julia. I
Yeah,
can't
please
type
do.
fast enough. I just want to make sure everyone is clear that at the Carrot Project, we advocate for putting your labor or all of your potential replacement labor into this equation, meaning you never know when you're going to break a leg and have to hire someone to take over what you were doing just to stay in business. And if you don't factor that concept into your break-even analysis, essentially you're not going to break even if that catastrophe hits you. So we always say, put it into your planning. I guess ultimately our conclusion is, and if it doesn't happen, well, you're that much better off.
Yep. And as Kian said, even if you're not paying yourself in actual dollars, pay yourself on paper for your projections, so you're building it in, which is exactly what Jeff just said as well.
Could I ask, make sure that I understood what he said? He said you have to plan for emergency. Is that that's what he said? You may have a business and you're out sick for a couple of months and you have to plan for that?
Well, it's not so much that you have to plan. I mean, yeah, you have to plan for emergencies. You need to, you know, something is going to go wrong. But as you do your analysis, I think a lot of times farmers say to themselves, well, my time is free. I don't need to pay myself. And maybe you don't pay yourself, but you need to plan that into your cost of production and into your break-even analysis, because if you break a leg and can't do the work, your business is going to fall apart if you haven't built in the cost of your labor into your economic model. So it's really important to account for your cost in the planning, because if you can never afford to pay yourself, then it's not a viable business. So you need to build it in. Even if you don't actually pay yourself, you need to build into your model that you will pay yourself.
Okay, great. Thank you.
Certainly. Any other thoughts from folks on how you're thinking about break even and planning for profit? So over the last few weeks, we talked about several tools. We talked about the bookkeeping system, and your record keeping system is what's going to help you have these numbers to do the analysis so that you can reflect on historical years to see how you did, to compare your projections to actuals. And with the bookkeeping system, you can then, have the numbers that you need to do future analysis, whether it's scenario planning. Can you afford to build a farm stand? What would it look like? Break-even analysis, having your historicals to plan ahead. And all the concepts sort of intertwine. And we talked about sort of 4 discrete tools, but they all link together. So, if you're doing scenario planning, you need a cash flow budget. And if you're doing a cash flow budget, you need to be able to set revenue projections, and you set revenue projections by doing break-even analysis. And they all kind of work together, even though we kind of talked about them in isolation. But these are just, ways that you can use these tools to help you make informed decisions to improve profitability and ensure your long-term financial viability. So I just wanted to make an additional shameless plug. I think I've been shamelessly plugging Carrot this whole time. But we want to help you be successful, and we have a lot of programs to support farmers, including one-on-one business assistance. We have loans, we have online resources. Somewhere in the chat, there's the link to the webinars that we recorded. Also on the website, we have some templates. We will also email the templates that we use today. And obviously we offer trainings like we did over the last 3 weeks. We want to help you succeed. So feel free to email Jeff. Here is his email address, and we will do what we can to help you.
Well, certainly, and thanks, Julia. A quick note, the template portion of our new website is not yet functioning properly. I would say don't rely on it. Email me and I'll send you templates directly. I know it's a little bit of a pain, but that way you can be sure that you get it or get the right one. I also want to tell everyone in this training series, we have decided to hold open office hours. They'll be next Thursday, well, they'd be Thursday, November 11th from 10 until noon. I will be getting your emails from Mary. I think I might have them all, but we'll just confirm I have them on. I'll send you out an invite. We're going to do it on a registration basis simply because we want to know how many people are thinking of attending, and we'll take it from there. Kian and Julia will be on. Julia for part of the morning, as I understand it. I'll be on it as well, but more listening than answering questions. And this will be an opportunity for you to ask any follow-up questions you have about any of the 3 days of training, as well as ask some specific questions relative to your business, depending on who's there when you ask the question, right? It may be public. We're not going to record it, right? But there may be other people that are involved. In those circumstances, we do and always will ask people to treat these sessions with confidentiality, meaning you don't talk about it with anyone else. And certainly if you're uncomfortable in the group setting, we can set up a one-on-one session with Kian or any of our other business advisors that are particularly well suited to answer that particular question or set of questions that you have.
And I want to also add that, we did talk about these 4 tools: break even, cash flow budgeting, scenario planning, sensitivity analysis. And if you want to take some time this week to practice with your own numbers, we can then go over that next week together to see, because obviously it looks nice and easy here when we're doing it for you, but when you go home, it may be more tricky, especially the person who is asking about multiple enterprises. So, practice on your numbers, bring them in, and we can figure out how to fine tune what you're doing. And thank you all very much. Mary, did you want to offer any closing remarks?
I'd like to thank you all, Julia, Jeff, and Kian, for doing this series. It's been terrific. They are recorded. I will be sending the link out. We have to have closed captioning on this as far as UConn is concerned. So once they get the closed captioning onto these, they're going to be uploaded to our website, and I will email a link to everybody for all 3 of these. So thank you again very much.
Thank you all. Have a great evening, and we'll hopefully see you next week.